I'm Rose Lance Roberts. Michael Lebowitz, CFA, joining me as well. Talk a little bit about the Janet Yellen pick as Treasury Secretary. What does that mean? And again, we kind of went through that. And here's the interesting kind of dynamic about this is that, you know, there's a lot of conversation here lately by economists. Oh, we need more stimulus. But actually, the economy's not doing too bad, right? Services PMI from market just hit a new high yesterday. Manufacturing PMIs are hitting new highs. Employment's been recovering to a degree. Are we back to full employment? No, we're not, but it's certainly recovering here. And we're seeing people going back to traveling, eating out. We saw over 1 million flyers over the weekends. People are getting back to living, right? I mean, they're going back to doing what they're going to do. And a lot of hope here is that, you know, if we get a vaccine, well, that's just going to unleash this huge amount of pent-up demand that people have because they've been sitting at home on all this, savings that they've got because they haven't been spending any money. But the reality is that's not true at all. We saw, right after the pandemic, of course, massive amount, we saw $1,200 checks to households. We saw extended unemployment benefits that gave people up to $600 more a week than they were making even when they were working. All that money's been spent. So whatever pent-up demand there might have been, right, from having a recession and a shutdown, we actually fueled a pull forward consumption in the economy, which leaves now this gap to fill in the future when we get there because of just there being a lack of that stimulus. So there's likely not this big pent-up demand that's there. But the stock market, as I was talking about a second ago, the stock market is right now, by any measure, extremely overvalued. And we took a look at what we're paying for cash flow and paying for earnings. We're paying an exorbitant amount in terms of valuations for stocks. A lot of companies are what we call zombie companies. They only exist because they can take on cheap debt. And in a lot of cases, companies are actually generating lower rates of revenue growth, but are trading at really astronomical valuations. And of course, there's just a tremendous amount of speculation in the markets. People are chasing, green energy companies and a lot of other assets that really have no real value to the company, but they're buying it just in the hopes and because of the fact that they're just going up. So lots of speculation in the markets, high valuations, lots of bullish sentiment. Mike, doesn't seem like anything here can really go wrong. I mean, valuations are kind of passé. Nobody cares anymore.
Right. It's become a casino, right? I mean, that's what the stock market is slowly becoming. It's a casino where people are betting. They're not investing. Investing is about growing your wealth over long periods of time. Betting, speculating, trading is about making quick short-term gains, or that's the stated goal at least, right?
Right.
And if your goal is to make money today, you don't care about fundamentals. You don't even really care about technicals. All you care is that what you buy today goes up throughout the day and you sell it, right? Your holding period is hours, minutes, maybe a day or two, right? So any of the underlying concerns that one should have about stocks, especially at these levels, because we're approaching levels that have, we've gone past 1929, and now we're only talking about some valuations from the late 1990s, right? The tech boom. So, the question I think you have to ask yourself is, are you a gambler or are you an investor? And the honest answer, I think, is that we have to be a little bit of both, right? And it's scary, right?
Right.
But long-term investors understand what's going on, and they should be scared of the market, frankly, scared of what's going on, because every time we've been at these kind of valuations, there have been major corrections. But what's going on with the government, with the spending, with the Federal Reserve just continue to keep their foot on the gas pedal, tells you that there's a lot of liquidity. That money is not going into the economy. It's not being invested. It has nowhere else to go. And stock prices can keep going higher. Even though they're egregious, they can be more egregious tomorrow. And those that are in place to short the market are long gone. They've been taken out on stretchers, right? So there's no police for this market.
Right.
No one's shorting this thing. No one is telling you to be worried. There's nothing to be worried about here, right? Who's out there voicing any concern.
Well, and that's kind of the point here is that, the last time we saw, this type of record inflows into markets, and over the last 2 weeks, we've had record inflows into equity markets. And last time we saw this was in December of 2017. And this is when we were passing the Tax Cut and Jobs Act under Donald Trump and lowering the tax rate. And everybody was trying to rush into the markets to get ahead of lower tax rates, which meant higher corporate profitability, higher corporate earnings, wanted to get ahead of that valuation adjustment. And of course, 2 months later, February, we had a 20% decline in the market. So you're seeing the exact same kind of, input into the market currently, this kind of wild, reckless abandon. But I guess one of the questions is where, not only are there no people shorting the market, and again, as you said, they're kind of like the police that people that short the market, they actually provide a service by providing the other side of the trade, right? And right now, they're not shorting the market, so you have really a lack of sellers, and we're getting to the point to even have a lack of buyers because there's only so much money being available to put into the market. The average person, in the country, 80% of Americans have less than $500 in the bank. They're not the ones buying the market. So where's all this liquidity coming from?
But think about that, Lance, for a second. Like, that's a very important point you made, right? Mm-hmm. Lack of sellers. Potentially, we're getting to the point where there's a lack of buyers, right?
Right.
What is liquidity? Liquidity, when you have a lot of liquidity, that means you have ample buyers and ample sellers. So that when stock prices move, there's a lot of buyers and a lot of sellers. So stock prices are gradual. They can trend up, they can trend down, but they tend to be very gradual because there's a lot of players involved to help regulate that price.
Right.
Right. Now what you're saying, and I'm on board, is that who else is going to buy that hasn't bought? Right. That number's coming down quickly. There still are potential buyers. Right. Mm-hmm. And who's selling? There are none. So what we end up with is a potentially very dangerous market, right? Again, doesn't mean it may not go up, S&P may not go up 1,000 points, but it can also drop 1,000 points. Whereas when we were talking about normal moves a year ago, we may have been talking about, well, the S&P may go up or down 50,
right,
75. You're amplifying the potential volatility because there is no liquidity. And we see this with the gaps in the market. Right. All of a sudden, the market will just shoot up 0.5% in minutes on next to no news. That's illiquidity.
Right. Well, and to explain this, I guess, so people understand, is that in order for there to, people hear this this kind of, Wall Street wisdom from time to time, is for every buyer, there's a seller. And which is absolutely true. In order to have a transaction, you have to have somebody willing to buy and somebody willing to sell at a given price. The problem comes, as you're talking about, the reason there's this liquidity issue is that when you don't have anybody selling and everybody's buying, at some point, if there's a catalyst, right, some type of event, right, and these catalysts, these events are things that we don't even know what they are. I mean, we can, like in today's Technically Speaking post on our website, we lay out a laundry list of potential events. It will be none of those. I can tell you that, because the one thing that shows up that gets the market is a thing like a pandemic. Nobody counted on a pandemic and shutting down the economy, right? That wasn't even on the radar. That's the way it always is. But the problem becomes is that when that event occurs, sellers that were vacant to start with completely evaporate. They're not, they're not willing to buy at that point. And so everybody that's been long stocks, they try to start selling. And when they try to start selling, there's nobody there to buy. And there's some guys way down the list somewhere say, yeah, when you get down to my price level, I'll buy that from you. But that could be 10 or 15 or 20 or say 35% lower, as we saw in March, before those buyers start stepping in, in force. And that's where investors really get caught up here. They don't realize that a lot of the speculative investments they're making have huge downside risk because there's nobody willing to buy that stock until it drops a lot.
Right. And I think a lot of people say it doesn't matter. The Fed has my back. And maybe they're right. Mm-hmm. But the Fed, right now at least, does not buy stocks.
Right.
Right. The Fed is the rah-rah cheerleader that gets everyone playing hard and buying and all that. But at the end of the day, the Fed may not be there. Right. At some point, the Fed will be there and they will buy stocks and they will prop this up. They will prop it up. But but the Fed does not buy stocks, and they buy bonds, but there are only so many bonds to buy because they're taking all those bonds.
Right. Well,
right?
Look, this is the same problem that Japan has run into. It's a great idea that the Fed will buy stocks, but eventually at some point everybody just starts selling all their stocks to the Fed. And the problem becomes is that you begin to distort markets, because when the Fed owns 80% of the stock market, like Japan owns 80% of the ETF market, you don't really have a market anymore.
Right.
And so then this becomes a lot more difficult and then what happens? I mean, eventually the Fed has got to sell to somebody. And if they want to reduce the amount of equities on their book, right, they've got to sell to somebody. If nobody's willing to stand there and buy from the Fed, well, if you're selling and you're the sole proper upper of the market and you're wanting to sell, I'm not buying, right?
Right.
So there's and it may be years before you get there, but there seems to be a huge problem with this whole theory.
Right. One of the main principles of capitalism is free markets, and we are erasing a huge part of capitalism. And with that, the benefits of capitalism go away.
All right, be right back after the break. Got a couple other topics to get into real quick with Mike Lebowitz as we wrap up today's edition of the pre-Thanksgiving show. Don't go away.
And the words are really clear, so beat it, just beat it. You better run, you better do what you can. Don't wanna see no blood, don't be a macho man. You wanna be tough, better do what you can, so beat it. But you wanna be bad, just beat it, beat it. No one wants to be defeated. Showing out, lucky, strong is your fight.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Long-term care is the financial elephant in the room. The median national cost of a private room in a nursing home? $8,517 a month. Are your finances prepared to handle that burden? Our next Candid Coffee with Richard Rosso and Danny Ratliff can show you how to protect your finances from the effects of a long-term care event, the myths to ignore, and how to prepare a plan to address the cost. Register for the special long-term care edition of Candid Coffee, Saturday, December 5th at riaadvisors.com.
You're listening to The Real Investment Show